Hello students and welcome to this second explanation on cost plus pricing. This question is called Zozo Limited. I want us to read together. The question reads, suppose that Zozo Limited applies a cost plus pricing method in determining its selling price. The entity applies marginal costing. The normal production capacity is 15,000 units per year, and the following information relates to the entity. For direct material, it's 250 Rand a unit. For direct labor, it's 120 Rand a unit. The variable manufacturing overheads are 70 Rand and the variable selling and admin costs are 20 Rand per unit. Then they've given us in total the fixed manufacturing overhead, which is 60,000, and then also the fixed selling and administrative costs, which amounted to 22,000 Rand. If we go to the required part of this question, it says in A, determine the selling price per unit if the markup is calculated as 60% of prime cost. So again, we need to make sure that we familiarize ourselves with the necessary definitions. Then in number B, it says determine the selling price per unit if the markup is calculated as 70% of conversion cost. Again, we need to know how conversion costs are defined. Then they say determine the selling price per unit if the markup is 35% of the marginal cost. Again, we need to know what the definition is of marginal cost. Since we are using marginal costing, we will have to refer to our marginal layout, which means that we split the costs between variable and fixed cost, right, in our income statement layout. Then for required D, it says determine the selling price per unit if the markup is calculated as 90% of production cost. So again, we need to know how production costs are defined. So if you go back to the slides, it is indicated how production costs should be calculated. All right, let's look at the answers to the required part. For number A, we need to calculate 60% of prime cost. So for prime cost, I know it has two little legs. It's direct material and direct labor. So you can imagine how you will run into trouble if you don't know the meanings of things like conversion cost, marginal cost, prime cost, so things such as that. Right, we need to get to our prime cost then. So for the prime cost, we need to go and look at the direct material given in this marginal costing question. It is 250 Rand for the material and it's 120 Rand for the labor. To get to the prime cost, these two need to be added together. Right, then we need to add our markup. And the markup is equal to 60% of the prime cost. So it is then the 370 times 60%. And that gives us a markup of 222 Rand. Our selling price will then be the adding of these two together. So that's 370 plus the 222. And there we have solved the required number A. For required number B, it says that we need to calculate the selling price. The markup is 70% of conversion cost. So now we need to go and calculate the conversion cost. So what is conversion cost? Conversion costs are the things that we need to produce a product that are not direct material. So that would be our direct labor, our variable overhead, I can ever spell correctly, and then also our fixed overhead. Right, direct labor, that was given as 120 Rand a unit. The variable manufacturing overhead was given as 70 Rand. Then for the fixed overhead, we run into a bit of a challenge here because you will find that the fixed manufacturing overheads were not given per unit, right? They were just given per total. So what we need to do is calculate it per unit because we cannot take per unit values and then add totals to it. That does not make mathematical sense. So if I look at my manufacturing overheads, it's worth 60,000. And in the introduction, they told us that 15,000 units is the normal production capacity. So now we can go and determine, but what would the manufacturing overhead then be per unit? And in calculating that, I'm going to take the 60,000 and I'm going to divide the 60,000 by the number of production units, the normal capacity. And if I do that calculation, I get 4 Rand fixed overhead per unit. Now I need to add this together to get to conversion cost. So the total conversion cost is the 120 plus the 70 plus the 4 Rand. And that gives us 194. The markup should be 70%. So for the markup, we're going to say it's 194 times the 70%. And then I'm going to calculate my markup so that I can get to, of course, my selling price. And the selling price will be these added together, the conversion cost total plus the markup. Right, so this means that in terms of the markup as based on the conversion cost, our selling price will be 329 Rand and 80 cents. Moving on to required number C, it says that we need to determine the selling price per unit if the markup is 35% of marginal cost. Right. So for marginal cost, let's go back to the slides and see. Marginal costs are direct material, direct labor, variable manufacturing overhead, and variable selling and admin costs. So if we look at our marginal layout, it's demonstrated as well that it is the material, the labor, the variable manufacturing overhead, and the variable selling and admin all added together gives us marginal cost. Okie dokie. So for number C, I am just going to be lazy and I'm going to copy the words I've already typed. So we need direct material, we need direct labor, we need our variable overheads that are manufacturing in nature, and then we also need our variable selling and admin. Right. So for the direct material, it was 250. For the direct labor, it was 120. The variable manufacturing overhead was 70, and it was 20 Rand for the variable selling and administrative costs. Adding all of it together to get to the marginal cost. It gives us 460 Rand. We need to calculate our markup. It should be 35%. So it's going to be the 460 times the percentage given. and the markup is 161 Rand. Total selling price will be the marginal cost and the markup added together, which is 621 Rand. Moving on to the last required part, number D, it asks us to determine the selling price if the markup is 90% of the production cost. Right, so how do we define the production cost? The production cost is the direct material, direct labor, manufacturing variable overhead, manufacturing fixed overheads. Right, so again, I'm just going to be a bit lazy, copy the words for number D, and then of course we have to add there the fixed overheads. So now for the direct material, it was 250. For the direct labor, it was 120. It was 70. And then for the fixed overheads, we have calculated that one in number B because we had to calculate it. It was given in totality. So it was 4 Rand. And then to get to production cost, we have to add all of this together. Which is 444. We have to calculate our markup. And the markup should be 90% of production cost. 444 at 90%. And then we're going to add it together to get to our selling price. Selling price 843 Rand and 60 cents. Right, so that was the answer to the question Zozo. And I sincerely hope that you have enjoyed this video. And then I will see you in our next lesson. Keep well until then.